What's up, everybody? It is Wednesday, May the 4th. Lots to talk about. We've got the Fed, we've got interest rates, we've got what was really said by Powell, what it means for you, and what it means for the market. I'm your wealth guy. Let's talk money. Let's talk market wrap up. All right, so like I said, there's a lot to talk about, but first I want to thank you for tuning in, for watching what I have to say. If you do like what I have to say, please, I would appreciate it. Like, subscribe, share. Much appreciated for those of you that have tuned in. Now, let's talk about the markets today, because if we take a look at the markets overall, what an incredible run to the upside after struggling for roughly 2 weeks. We have the Dow up about 140 points at close. The NASDAQ, which from a percentage perspective, closed the highest among all other indices at about 400 points. That's about 3.33%, if I'm not mistaken. Now, the S&P 500, which is the broad stroke of the market, is back out of that correction territory that we did talk about on Sunday. What an incredible day. Well, let's take a look at what happened and what triggered it, because a lot of people are going to say, well, the Fed's 50-point increase is what really pushed the markets higher. And yes, no doubt, the markets did push higher with the Fed's increase of that 50 basis points. But keep in mind, that was already anticipated by most traders, most analysts, most fund managers. Pretty well most people out there were anticipating the 50% or 50-point hike. In fact, the 10-year yield was already pricing it in for weeks now. But what really pushed the markets higher was Powell's comments on, I would say, a very non-aggressive position in regards moving forward. So we know for sure 75 basis point increases are off the table. They will, however, consider 50-point increases going forward. But that doesn't guarantee that you're going to get 50 basis points. Now, I'm not going to assume that we're going to see more interest rate increases. I'm not going to assume that. I'm not going to assume that we're not. I'm going to probably play on the side of caution, saying that we will at least see one more bump to interest rate. But in June is when the Fed will start working on reducing the balance sheet. Now, the truth of the matter is that's really neither here nor there. If we take a look at everything overall, if you think that the Fed is going to stop printing money and therefore allowing inflation to continue to increase significantly, then I don't know what to tell you, because the reality of the matter is when we're looking at the Fed and printing of money, it's really just going to go from one crisis to another. So we have a war overseas in Europe. We have a food crisis. We have an energy crisis. And who knows what other crisis we're going to have coming up down the road that's just going to require more money being tossed at it. And you can expect the Fed is absolutely going to keep printing money to help fund these crises in one form or another. So at the end of the day, you can anticipate that inflation will continue to go out of control. Never mind the fact that these small increases in interest rates really are not going to curb inflation whatsoever. We've already covered the mathematics as to why, even though it was very general. But the truth of the matter is it's not going to curb inflation. In fact, it's probably going to help accelerate inflation even further. I did see statistics today that our food inflation in the U.S. in particular has now been calculated about 30% increase year over year. Now in Canada, just walking through the grocery store, I can already tell you I've seen the 30% increase depending on what you're looking at. So to say that 30% increases are outrageous and unreal, I'm not going to buy that. I'm going to say they're absolutely in line with the truth. But as I mentioned, the Fed going to cut or reduce their balance sheets. Not going to happen. Going to really do an impact on inflation. Not really going to happen. But the 50% bump today, or 50 basis point bump today, great for the markets. Markets loved it, ran with it. The fact that we're not going to go into 75 basis point increases, the markets also love that even more, especially tech, which we know is very interest rate sensitive. But that's it pretty much for everybody. We'd like to see a continuation of the markets going upwards here. If we don't, and we see a little bit of a pullback, could be a problem because it'll just confirm that the momentum to the upside isn't quite there. I'm on the side to believe that the markets will continue to push upwards. It's not going to be a nice parabolic run, and I say that very hesitantly because parabolic runs to the upside are definitely not nice. But I don't believe it's going to be parabolic. I do expect a little bit of a pullback, not necessarily tomorrow, maybe into Friday, just because it's going to quiet down, not so much negative momentum. If we do, like I said, continue to see more upside here, we could very well see all-time highs in the near future, which I did mention about 2 weeks ago that I do anticipate that before we had that couple heavy hits there. But that's it, everybody. That's it for today. I know Wednesdays aren't my usual day to post. However, I do want to try to post a little bit more frequently. Otherwise, I will see you on Sunday when we do our market preview for the week.